So we are back with the next talk of our today's Blockchain Community Day 2024 conference. And this time we would like to invite our next guest who will be delivering a talk about investor insights on future digital assets. And I'd like to invite our today's guest, Jason Fernandes. I hope everyone can see you now. Hey, hi, how are you?
Everybody, hope everybody can hear me okay.
Yeah, we see you, we hear you well. Thank you so much for joining and for being with us today. I think we will be, we lost your video, but I think we can start sharing your presentation, and during the process of sharing, you can say a couple of welcoming words and introduce yourself, and after that, we will be good to start.
Sure, do that right now. I'll be able to do it with. I'm just going to add my slides. Just give me 1 second.
Yeah, sure, no problem. I just would like to remind everyone to join our Telegram chat to keep the discussion of the topics. Since we have a pretty short timing of our sessions, we can continue our discussions in our Telegram chat. And if you have any questions, just leave them in the live chats wherever you are watching this, in the comments section, in the live chats, in the Q&A sessions. And I will try to distill all the questions at the end of today's session and ask and read them aloud by the end of our today's talk with Jason. Please, Jason, let me know if everything's fine with presenting.
Sure. What I'm going to do is just share my entire screen in that case.
All right. Yeah, no problem.
Okay, here we go. Okay. Cool. So very quickly, thank you everybody for coming. I appreciate the invite. So my name is Jason Fernandes. I'm with AdLunam Inc. Essentially, what we do is we take projects from very, very early stages, what we call zero to their IDO or IEO at their public sale. So we essentially ensure that projects that have really good businesses, but maybe are not don't really understand how to launch a token, are able to have really good token sales, and that ensures that involves connecting them with institutional investors, advisors. We have an advisor panel, institutional investors, exchanges, and some of the top companies in the world to essentially make them launch. And so a lot of what we do, we're obviously an investment platform. So a lot of what we do is
so sorry to interrupt you here. Just I'd like to let you know that we see your screen is pretty wide, and maybe let's try to do it a full screen so that it's not. I think you have a very wide screen, and we see it very narrow. Yeah.
That's right. I got it. Okay, let me see if I can. Yeah, perhaps. I'm not sure what the button is. Oh, here we go.
The slideshow button on the right.
Yeah, I don't really see. Oh, it's this one right here. Okay, perfect.
Yeah. So yeah, perfect. Now it's okay. Visible.
Okay, great. So it's essentially a lot of what we do is, since we're an investment platform, a lot of what we do is talk to a lot of projects in the early stages of looking for funding. Now, my personal experience, my background personally is in investments. I headed investments for NFT technologies, NFT tech, invest in a lot of projects in the Web3 space prior to going public in Canada on the Canadian Stock Exchange and NEO. And also in Germany, and then subsequently, of course, my focus shifted to AdLunam. So we talked to a lot of projects looking to raise funds, and what's extremely important when it comes to that is especially when it comes down to investing those funds on a token basis, it massively matters sort of how that token is structured, right? So I know a lot of y'all are developers. and so your focus is mainly sort of building a really good project, and building a product that's interesting and that people want to use. That's one part of this. But the other aspect is, if you're going to launch, let's say, if you intend to take that business and somehow launch it on an exchange, on a cryptocurrency exchange, ultimately you'll need tokens. And what you'll need to do is imbue these tokens with utility and use case to where people buying that token are essentially buying into your business, right? So now, in a typical investment model, like in an equity investment, a company a VC will come in and they'll make an investment. They'll take a certain percentage of the company. What's in contrast, crypto companies have a unique sort of funding model available to them, and that is selling not a share in the company, but directly the utility that the company supplies itself. So, for example, it's very simple. If you wanted to set up a business, let's say around a arcade game company, right? So, for example, you could take investment from your friends and neighbors and stuff, and say, hey, listen, I'll give you a share of the company. You could put some money into me, and then when we make a profit, I'll share that profit with you. That would be one way to make one model of raising funds. The token model would be slightly different. And essentially what you could say is, when I launch, I am going to be opening up this arcade. And when I open up this arcade, I'm going to be selling tokens to play the games at, let's say, $1 each. I am pre-selling those tokens at 25 cents, or let's say 20 cents for each token. And so if you believe in me and you believe that I will open up this arcade, then you can pre-buy these tokens from me at, let's say, 10, 20 cents. And then later on, when I launch the arcade, you could either use it yourself and get $1 worth of value out of it, or you could sell it to somebody else, presumably for $1, because at that point, nobody will be able to buy it for less than $1. So ultimately, what that means is what you're doing is directly selling the utility of the business rather than a share in the business. It's just a different value, a different way to assign value. And so from a technological perspective, from a technical perspective, it's almost trivial to create new tokens. So a lot of you guys are developers, you guys are ERC20 developers, for example, some of you are, and it's very, very easy to sort of, just create a token. I mean, I'm not saying it's super easy, but of course, it's been done before. It can be done, right? The key thing that makes it challenging is to sort of ensure that the business, whatever value that the business is putting out, is aligned with that token. So you can generate, let's say, 1 billion tokens, and you can say, each token we're going to assign a value of XYZ to. But then you have to ensure that the business supports that, right? So the price that you're assigning that token, let's say the value that you're giving for that is right, because otherwise that token will drop in value, because eventually that token will hit an exchange. And at that point, the market determines the value of the token, not you, right? So it's really important to create sustainable token economics models. Most commonly, there are sort of 3 general types of tokens. One is sort of a utility token, and that's what I've been describing. Essentially, the utility is where the value is directly ascribed to the token. Another is a security token. Now, one could, if you're selling, let's say, a part of something with the expectation of profit, then it would be classified as a security token. Now, a security token follows essentially very closely securities regulations wherever you are as an investor, right? So if you're American, you're not able to invest in security tokens, securities, or security tokens for that matter, unless you're an accredited investor, which means you have to have at least $1 million in funds, and there's certain other things to do before you can be an accredited investor. And once you're an accredited investor, you can then make these investments, and that's essentially to protect investors, right? And so the key thing about security tokens and utility tokens, and the thing that differentiates them is mostly regulation. There's a lot of regulation around security tokens because, as I mentioned earlier, the regulations around that are similar to just if you were to launch a security like on the stock market, for example. I mean, there are some exceptions, but that depends sort of where you are launching from. So, so for example, in Zug, Switzerland, they're slightly more liberal about what they consider a utility token, for example. But ultimately, the thing that differentiates a utility token and a security token is a set of rules known as the Howey test, right? So the Howey test was by the SEC. Essentially, it refers to a particular case, and it's a multi-pronged sort of test where, if people are working together toward a common enterprise, and essentially that goal wouldn't be reached if it wasn't for a centralized body taking some action, then essentially what you are doing is you are relying on that particular organization to increase the value of the token, which basically means that organization has sold a security. Now, if that is sufficiently decentralized towards that to where value in that token comes from the community at large, then that could be termed as a utility, right? So, for example, Ethereum is a good example. I'm going to get into here. Ethereum uses a utility token model with staking. So, for example, as you guys know, Ethereum is basically the gas that lets Ether is the gas that makes Ethereum run. And so, you buy Ether and then you use it in the system, right? Same thing with Chainlink. Chainlink has a utility token where you essentially have to buy the token, then you use that token in order to access their Oracle services. MakerDAO has a governance token model where you have the ability to sort of vote on protocol changes and risk parameters. Now, a governance token, these things are slightly more nebulous in terms of what they can describe. Usually, you would say a governance token is a utility token because it gives you the utility to vote. But a lot of companies will maybe launch a utility token and a governance token, and then that sort of the interplay between that becomes important in terms of being able to define whether it's overall a utility or if it strays too closely into security token areas. So very quickly, the important thing to do to build sustainable tokenomics is defining the clear objectives rather. And so, what are you trying to achieve? You want to sort of explain that out. The roadmap, when you expect to reach there, how you intend to grow. You also have to incorporate governance mechanisms. So, for example, very often, because crypto is considered a very democratic sort of concept and decentralized, oftentimes you'll have decision making where community will vote on major decisions. So that is an example of that would be MakerDAO, like I mentioned earlier. Another is sort of ensuring transparency and accountability. So that's trust building, regular updates to basically people that invest in a token, financial rewards, and essentially making sure that you shepherd the funds that they give you in a good way. Now, another thing that's important is vesting, right? So, for example, you might, when you launch your token, you'll have a certain percentage of that, and I'm going to jump into this much later when I talk about tokenomics. But when you launch a token, you'll have to sort of determine what percentage of it goes to what section, right? So generally speaking, you'll have something like anywhere from 15 to 20, 21, 25% even sometimes go to the team and advisors. And that's to sort of motivate the team and like both founders, team members, and also advisors to help you build this, right? Another is sort of you'll have a community budget. So you might say 20% of the tokens are earmarked for community. So that's community growth activities, whether that's helping pay for airdrops, whether it's helping grow the community in other ways. And then you might delineate a certain percentage of it for marketing tokens. And so you essentially have this big pie, which represents 100% of the tokens, and then you cut out little sections based off of who gets what. Now, usually you'll have a public round that will be less than 1 or 2% of the total percentage of tokens when you launch your IDO. You might give, up to 9%, 10% in a private round, maybe 5% in a seed round. Generally speaking, before you launch, you want to have around under 20% of your tokens out before you launch on an exchange. You don't want too many of your tokens distributed, because what that would do is create sell pressure once that token hit an exchange. So the sort of some of the very, very important sections would be your fully diluted valuation, and then, for example, how much of your circulating supply is circulating, how much of your supply is circulating at the time that your token becomes live. So there's a term called TGE, that's token generation event. That refers to essentially the time that you generate your token and put it on an IDO, on an exchange, on a DEX, or maybe a SEX, centralized exchange. And that all your vesting schedules are essentially tied to that initial TGE. So that vesting schedule could go over 3 years, it could go over 6 years, and so what you have is like a token distribution curve. So essentially that allows you to align incentives among team members. So if you ensure that the team members have their tokens being distributed, let's say 5-6 months past the TGE, then you ensure that all the team members are incentivized to make sure that the growth that the token sees is long term and not limited to the first 2 or 3 months, because their tokens, for example, may not even kick in until 6 months in and might go on for another 36 months before they're fully vested. So it allows you to align your incentives, the incentives of your team members, the early investors and stakeholders. So for example, your seed investors, you might really let them cash out a small little percentage of that, maybe 5% at the token generation event. So when your token hits the exchange, maybe 5% of the seed investor's total investment is unlocked to where he can sell it. Similarly, the private investors, they usually unlock about 10% at TGE. Now, my experience has been if you have a very good project, these projects can 10x or 20x at launch. So based off of their IDO price, they can 10 or 20x. So I oftentimes invested in projects. So in October of a couple years ago, we were very much in a bull run, and because of the way projects were launching, they would come to us for investment 2 or 3 days before they launched their token, essentially because they wanted to have us on their cap table, so that the retail investor could see essentially that they had a lot of institutional investor buy-in. By the way, I should talk about that a little bit. The way the retail investor makes a decision in terms of what tokens to invest in is highly tied to what institutional investors put in the first place. So what retail investors, smart retail investors, they look at some of the top institutional investors that have had very good track records. They look at some of the top launchpads that have very good track records, and they'll see which of these projects are launching on a top launchpad, have some of the top institutional investor buy-in, and then they'll basically go in and invest where those institutional investors are investing. Now, the reason that is because they're investing in the utility of a token. They don't have tokenomics experts to actually look into that. As a retail investor, they don't have tokenomics experts to look into that, understand exactly what that token is doing and whether there's value. So the only way for them to make that decision is they look at what the institutional investors are doing, what the launchpads are doing, what the exchanges are doing, and they use that as their due diligence, right? So that's why it becomes very, very important. If you have really good buy-in, you can have an extremely good launch. And like as I mentioned earlier, it's not unusual for tokens to do, let's say, a 10x, sometimes a 20x launch. And so, like I was mentioning, I invested in a lot of companies in October, in early October, that because they wanted us our names on their cap table, they would come to me maybe 2, 3, 4, 5 days even before their launch. And then I would make an investment, and then let's say, for example, they 10x or 20x, and let's say I invested in the private round. If I invested in the private round, what would happen is that 10% of my tokens are unlocked at TGE, which means when the token hits the exchange, about 10% of my tokens are unlocked. So if the company does a 10x, that means I get my entire investment back initially, and then whatever happens in the future happens. If they 20x, then I immediately get my entire twice my entire investment, and then again over the next several months, I'll get the rest of my of the returns. It might fluctuate some because sometimes you have a bear market that comes in the middle. So that's why token distribution is really, really important, because you ensure that the team members are incentivized to stick around, the early investors are incentivized to stick around, the stakeholders are incentivized to stick around. So you want to control the supply and gradually release the token, because you want to prevent people from dumping that token, because you assume that any amount of the tokens that are released are likely to be sold on the exchange, and because the exchange is essentially heavily dependent on essentially it's a free market, right? So there's a buyer. If there's not a buyer for the token keeps dropping in price until there's a buyer at that price. And so, of course, market makers can sometimes mitigate this, particularly in centralized exchanges, to some extent. But that doesn't come free, because, of course, you have to supply that liquidity for the market maker to make those decisions. So it's really important to control that supply and to ensure a gradual release over several years to prevent your token from going through a massive sell pressure in the initial period. One thing that's really important is the sort of, like I mentioned earlier, so circulating supply at TGE. So the fully diluted value at TGE, that's what's known as the FDV, that's determined by looking at the IDO price of the token and multiplying that by the total number of tokens in the system, right? So that gives you the fully diluted value of the company from a token perspective. Now, the circulating market cap, it refers to the actual amount of that value that is circulating, out in the wild, and could presumably be sell pressure. So sometimes when you are at your token generation event, when you launch your token, you might have, let's say, 5% of the tokens from the seed round be released, 10% of the tokens from the private round be released, and then not much else, which means only a small amount of tokens are out in the system. And so when those tokens hit an exchange, you can massively control that liquidity. And then because there's a limited supply, the price of those tokens can only go up. So clear vesting schedules help build trust with the community and investors. So obviously, if you have a long enough vesting schedule, investors are aware that the team members are aligned to build this company over the long term. And so is the community. The community understands that you're looking to build this company over the long term, particularly because the vesting schedules are so long. So again, I know a lot of you guys are really focused on development, but this is highly important, because once you develop whatever great product you have, the next step is essentially, and let's say you even have a token, the next step is aligning that token with the value that you're creating, and then ensuring that token has a good launch on an exchange. In order to do that, you have to go through this process. You have to understand your token, and you have to create a token that is attractive to investors, both retail investors and institutional investors. So a good case study is sort of Ethereum, Polkadot, Uniswap. So Ethereum, for example, they had a pre-sale, had a vesting schedule for the development team, so that ensured that these development team are involved in the long term. Polkadot has a staggered token release for its team early investors, so that's essentially to maintain its to prevent excessive sell pressure. And then you have sort of Uniswap, which has a 4-year vesting schedule for its team advisors, pretty much for the same reason. So how do investors evaluate projects and make decisions on investment in Web3? So this is a question I get asked a lot because I've made a lot of investments myself. I'm around a lot of VCs in this space, and I would say by far the biggest thing that we look at is team, and relationships, right? So and of course there's other things, and I'll get into that, of course, but I think the team is very, very important, because particularly when you're investing in a crypto company, there's very little accountability. There's very little in the way of an investor being able to hold that team to account, other than ensuring that let's say entrepreneur doesn't get funds in the future. And so if an entrepreneur's a goal is to just very quickly come in, make a quick buck, and then leave and let this company fail, there's not much you could really do about that. And so what investors tend to do is they tend to look for known quantities. They tend to look for entrepreneurs that have started a few companies in the past. Regardless of whether they're successful or not, if they aren't successful, did that entrepreneur take care of his investors? How did that work? What's his relationship with his investors? What's his relationship with his co-founder? A whole relationship with their co-founder. So these are sort of things that's super important, because it goes to the team members and their integrity, right? So I've made investments in entrepreneurs whose integrities have been questionable. Found out later, of course, that maybe they were not as dedicated to the project that they were pitching me as they led on. It's very hard to make that decision, so a lot of it depends uh, on instinct. Another thing we look at very, very strongly is institutional backing already, right? So it's very difficult for early projects. It doesn't matter if you've invented a cure for cancer. It's very difficult for those early projects to get a lead investor. And the reason that is because, again, as I mentioned, you're massively dependent on the team. So a lead investor is not just betting on the product that'll be successful, but he's vastly betting on the team, the entrepreneurs, and the leadership. And so that basically forms an endorsement that allows for other investors to feel confident about putting their funds in, right? So usually what will end up happening is, an investor will come up with will be presented with a project. He might like it. He won't commit immediately. What he'll do is he'll say, "Hey, let me show this to some of my friends," and he'll have a couple of his investor buddies that he co-invested on projects that also have their own individual networks that they can sort of and levers that they can pull to ensure the projects are successful. He'll contact them and he'll say, "Hey, what do you think of this project?" And if those guys say, "Hey, this is not a good project. I don't want to have anything to do with it," he will very quickly lose interest in the project himself. If, however, he feels like he's able to put together two or three, I'm talking about this is if there's not a lead investor. So if he's able to put in, two or three other investors and invest as a cabal, and each of these investors bring in unique resources and relationships that they can help the project with, then that lead investor could feel comfortable that these other investors that he's brought on will be able to get the project at least to the step where other investment is coming in. So that initial sort of check is extremely, extremely difficult to get, and in order to do that, oftentimes you would have to sort of get very, very close to an investor that believes in you, and then massively incentivize them to back you, because it's a huge risk for that investor to back you, to say that he's going to back you, and to back the idea, because if he's endorsing the idea, that he puts his reputation behind that. So it's very important to ensure that they're incentivized. So of course, timing is really important. So sometimes you have a certain narrative. So for example, clearly right now we have an AI narrative. A few months ago, we had a metaverse narrative. So metaverse projects were doing massively well when Facebook Metaverse came out. But these narratives shift, right? So I think soon we're going to see Bitcoin season coming. So a lot of Bitcoin layer 2s are going to be very, very popular. So these narratives can shift. And generally speaking, if you happen to have a project that ties into a narrative at the time when that narrative is hot, investors will put in money. So how important is it to have a working product or prototype? So I have a lot of parts in here. Yes, it does help to have a proof of concept, and it can significantly impact your likelihood of securing investment, but it's not critical if you have a really good team. If you have a really good team that's built products in the past, uh, let's say, for example, you have a CTO that has previously built a very, very large product. It's used by thousands or millions of people. That gives you the credibility that you can build what you have. Because what you eventually want to know is what you're doing is even technologically possible. So keep in mind that not all businesses are like that, right? Sometimes what you're doing is very, very technologically possible. The innovation comes from the how you are implementing it, right? Or the execution of that. Sometimes the innovation is the innovation itself. And in those cases, it makes sense to have a prototype because it proves that the innovation is real. But again, if what you're doing is not technologically impossible, then that massively lowers the importance of a prototype. So I've seen a lot of projects, they'll raise a small amount of money and they'll spend all of it on building development, and that's really not a good use of their money. Because what they end up doing is they spend all these funds. They have limited funds now to go raise more funds. Like usually, your first check should be focused on raising you more money, and that'll put you in good steed with other companies that you're competing with. Usually, you're raising about 2 or 3 million, 3 million, 2, 3 million. Um, Depending on the project, of course, but the average project is raising about that early. You don't raise too much because the tokens that you're selling at essentially a 90% discount vis-a-vis the price that token will be once it launches on an exchange. So you want to sell only the minimum level that you need in order to have the funds that you need in order to continue. I knew I know I'm just gonna almost done over here. So just go over a few case studies. Ethereum, of course, they had it working for the prototype. This helped demonstrate the feasibility. Chainlink also had an MVP. I'm not sure whether that was before they launched the token or not. Binance, before they launched their exchange profile, the exchange platform, they launched a beta version. So that allowed people to understand that Binance was legit. But again, if what you're doing is not technologically difficult and it's just a question of your execution of it that's going to be revolutionary, then building the MVP is not as important as just going out there raising funds and ensuring what you want, that the product that you're building is something that people will think is worth existing and that they'll pay money to have. So that sort of brings me to the end of this. Thank you so much for attending. I'd love to take any questions you have.
Yeah, thank you so much, Jason, for such a great presentation. I think this presentation is worth being cut into shorter clips and being promoted on every startup I know who are looking for investors right now. Very useful tips and guide. And I have a question. Let me quickly bring up the live chat. 1 second, please. So the first question says, how to encourage engagement within the token ecosystem and contribute to the enhancements of its sustainability?
Could you repeat that a little bit?
Yeah, how to encourage engagement within the token ecosystem and contribute to the enhancement of its sustainability.
Yeah. So I'll tell you that with projects in general, it's all about community. You live and die with the community because you have your diehard fans that really believe in the token and they'll buy your token. And without these people, your token is worthless, right? Because nobody will invest in your token without coming to a Telegram group. And if you alienated most of the people in your Telegram group, it will be apparent to other new people coming in. And so you, unlike a lot of, let's say Web2 companies, when you take in some investment, you might have 8, 10, 20 investors. With crypto projects, because they're immediately public, they're trading on an exchange. They essentially now immediately have thousands of investors, and so you really have to treat each investor as important in their opinion as something worth considering. Of course, you have to take that and ensure that you balance that with what's good for the company in general. But it's really important to make investors feel that they're heard. And so the community it all comes down then to the community and how you manage that community. And so to maintain engagement, it helps to do these things like, contests, giveaways, taking feedback from the community in terms of asking them what features that they want, what are the things that they're most looking forward to. So building that community engagement can be very, very, very important in making sure that your diehard fans keep holding your token. And of course, even people that maybe aren't contributing to your community, are maybe not engaging in your community, are watching that community grow and engage. And so they're making buying decisions based on how active they feel like that community is, regardless of whether they themselves are in that community.
Okay, yeah, and thank you for sharing this investors side of the situation. And I have a question about the most productive way of reaching out to investors. So could you please provide us a couple of tips and tricks?
Sure. So I think a really good thing is to look at investors that have invested in companies similar to yours. So, for example, if you're a launchpad, ensure that the institutional investors that you're approaching have previously invested in launchpads. If you're a game, ensure that that is a sector, for example, that that investor that you're approaching is interested in. A lot of times, investors will be interested in certain sectors, like they'll be interested even within crypto, for example. They might be interested in AI. They may be interested in healthcare. They may be interested in big data or metaverse. And you can tell that based off of their previous investments, right? So that's how you try to figure out who are good investors to approach. A lot of times, a particular company in this investor's portfolio might be a really good complement to what you are doing. And so that would be a good investor to approach, because let's say he might be able to put you in touch with that company, and now you're bigger than the sum of your parts. Meanwhile, there are some investors that maybe don't get along with other investors, so you have to sort of decide what clique you want to go with, and ensure that you're not, because some investors will not invest if other investors are on board. And so the best way to do that is to look at other companies and kind of see what is the cabals of people that have invested in them. So you'll see, let's say, what are the institutional investors in recent projects that have launched, and you'll see a few names that come up over and over again together, and you'll notice that these guys will tend to invest together. And so then those are the guys that would be good to approach as a cabal, because you get one, you'll likely get the others, and then you move on to the next. So that's sort of a good way of doing it. I think it really helps to lean on partners, relationships that you have with investors, or personal relationships that you have with investors, or, for example, a launchpad. So like AdLunam, for example, we have relationships with, I think, 40 institutional investors. We'll sometimes take projects to them, but usually it's projects that already have some institutional backing, because our investors don't like investing in projects that don't have at least some earlier institutional backing. So I think the hardest is sort of the first check. And then once they get that, it can move pretty quickly, particularly if they're rated, because most good projects, there's more money in the industry than there are good projects to put that money in. So once there's a good project, assuming you have the right investors in there, now that token is scarce, because there's only so much of those tokens that will be sold at a discount prior to that token hitting an exchange. At that point, the token will immediately 10x, 20x. So there's only a limited number of tokens that are even out in the system before that. And so once a company gets identified as a good company, it becomes very, very, very easy for them to raise funds, because they've already raised a certain amount. And so the other investors are sure that they will get to their goal. And so now it's just a question of who helps them first, and so who can get the greatest return on that.
Okay, thank you. And speaking about the stages, I remember you talked about having a working prototype, that it's pretty important to kind of affect the investors' perception about the startup. And my question is, isn't that too early to be at the stage of an MVP, or at the stage of a working prototype, to reach out to investors?
No. In fact, I've reached out to investors without even having an MVP, and I've actually got an investment. So it really depends on the team. So for a previous company, my co-founder was Gene Hoffman. Gene Hoffman went on to co-found Chia Networks with Bramco, and who founded BitTorrent. And so when we raised funds early on, we didn't even have a prototype, but Gene had built massive software on a massive scale, and had already sold his company for like ridiculous amounts of money. So there was no question about whether we could build it or not. It was just a question of whether we would build it, right? And so if your team is good enough, your CTO, for example, has enough experience building products on a massive scale, it's almost not even important to have the product built or even a prototype built. Investors will trust you if you give them your word that you're going to do it based off of your previous track record, right? If you have companies in the past that you've massively been successful, you're not going to be lying about this. So it's not as important as a lot of people think. And so, I've raised money. So with AdLunam, when we raised funds, we raised $1 million in 24 hours. We raised the other $2 million in like 5 days. And we didn't even have, we had a very, very, very basic prototype, like a version like -1. I wouldn't even call it a version 1. It was just very, very, very basic in terms of like, it could just sort of overall give investors an idea of what we hope to achieve. And then of course they trusted us, and subsequently we built the platform. We're on version 2.1 of it. And so we were able to prove our investors' faith founded. But again, what we were building was not technologically challenging. And so it was easier for them to trust us. Now, if we were saying something like, hey, we're going to do this thing that's never been done before, and it's highly technical, well, then it obviously becomes much more important to have a prototype.
Okay, so as far as I understand now, when the product itself is not that technologically difficult, it's pretty obvious for an investor for an investor to believe. And is there anything else that can be a strong evidence? If, for example, let's assume that somebody doesn't have a working prototype, but still he or she or they want to provide some kind of evidences that they want to make themselves to make the investor to trust themselves. And what could be other evidences that can make the investors trust?
Yeah, that's a great question. So I think, like I mentioned earlier, the team is massive. So if you're a founder, but you manage to recruit, let's say 2 or 3 other people, you better should get them to buy into your idea. And they are very, very legitimate people on themselves. So for example, a guy who has previously founded, a very successful company, he's now decided he's left that company, and now he's decided to come work with you. That's a huge vote of confidence, right? Sometimes if the company has partnerships, so let's say, for example, we had some very, very good early on partnerships with venture studios. So we were able to put that on our deck. So that helped build our credibility as well. Also, the relationships that we had. Then my previous background as an entrepreneur, I've been an entrepreneur since I was like 13. So there was quite a bit of information about me out there, and there's also quite a bit of information about both my co-founders. So I think that also helps in terms of building, building trust. So there's a lot of other things that probably are worth more, are probably more important than having a prototype built. And that I think a lot of that, because again, even if you have a prototype built, if the entrepreneur is somebody who's untrustworthy, then that doesn't mean anything, right? Because he could take your money, go off, blow it, buy a Lamborghini or whatever, and then you never hear from him again. So it's not just that the product matters, but also who that entrepreneur is, who vouches for him, what's his previous his previous history. Now, if he's been in a position where he could have, for example, taken money from, has he been in a position, for example, where he's been a custodian of a large amount of money? That matters as well, right? Because it's very, very, like, it's much more difficult than you would imagine for somebody to just hold on to like millions of dollars in this thing without just going off and spending it. A lot of entrepreneurs do just go off and start, going on spending sprees. So has this entrepreneur, previously been in charge of large amounts of money and been able to manage it in a way as opposed to just go blow it, right? These are things that you look at. So.
Okay, yeah, thank you. And so with the invention of such kind of investing platforms for attracting investments and so on, what would be the future of institutions like venture studios, like startup accelerators, innovation hubs, and other types of supporting institutions?
So I think they play a lot of they play a very similar role in that both launchpads, institutional investors, angel investors, they all go toward essentially endorsing the project, right? So for example, if an accelerator has decided to accelerate your project, that means that it's done a certain degree of due diligence on your project and has seen that your project is worth investing in, right? And so that's one degree of due diligence. If an investor does the same, institutional investor, that also tells accelerators, for example, that there's some something of value here. So it's sort of a combination of these things. I don't think any one thing is necessary over the other. So for example, can an accelerator take the place of a launchpad? No, because they all sort of play unique parts in their own ecosystem. However, every one of these things go toward building the brand's reputation and building trust in the brand. So, for example, if you're so I'm a mentor at the Stanford AI Web3 Research Lab, and essentially, of course, if you're supported by them, that means a lot. They have a really great brand. If you're supported by another university, that can also mean a lot. If you come through certain accelerators, that can mean a lot. So there's obviously a combination of these things. I don't think, and yeah, like I said, institutional investors, what a retail investor will look at when they're making a decision would be, what launchpad are they launching on? What institutional investors do they have? What institutional backing do they have? So maybe they have a partnership with them, with a really large brand. However they got that, it doesn't matter. But if they have that partnership, it matters. So for example, I invested in a project that was a web streaming platform. And I asked the guy, I said, hey, you have a lot of content here. Do you have the rights to this content? And he was like, well, my company has like essentially a permanent lease on the rights. And I said, well, how does that work? And so it turns out that he was like the son-in-law of the chairman of this company that owned all the rights to this stuff, and they'd essentially just let him use all the digital rights for all the movies that they made. And so again, it doesn't matter how this person is hooked up, what is it, but if they've got something that's unique, a unique USP that nobody else can touch, then that's something that you would definitely consider.
Okay, yeah, thank you. I think that was the last question, but still, if our conversation will keep going in our chat, I'd like to remind our audience to join our Telegram chat. If you have any questions, just ask them there, and we will be able to address them to Jason in the upcoming hours or days. Feel free to ask any questions, even if you're watching this as a recording. I think that's it for today, for this session. That was very insightful. Thank you so much, Jason, for coming with such a great content, for delivering such a great presentation, and sharing all that tips and tricks and methods and tools that startups can use to attract investments. I think that topic was pretty unique for our conference agenda. We were very, very happy to host you at the Blockchain Community Day conference.
Thank you so much. Thanks, everybody in the audience. Appreciate you guys listening. Follow me at jason.dotx and our company at AdLunam Inc. And yeah, feel free to shoot me any questions. Happy to chat with anybody. Thank you so much. Y'all have a great day.
Thanks, Jason. And we will be back in 10 minutes with our next session. So we have 3 sessions ahead today, and our next session will be dedicated to the topic of DeFi development trends 2024 and what we are building on top of it together with Artem Bessonov. Please stay tuned. We will be back in 9 minutes already.